Today, I'll be sharing 7 simple concepts and strategies to help tech executives and entrepreneurs create an income for life. I'm going to be sharing a lot of great ideas today, but before taking any action, please seek independent financial advice to determine what strategies are best for you. My name is Mike Sicker. I'm the founder and principal advisor of Delta Financial Group. I've worked as a stockbroker, mortgage broker, and financial advisor for the past 25 years and founded Delta in 2011. We specialize in working with tech execs and business owners to ensure they have a secure future and can leave a lasting legacy. We provide advice on all things personal finance, including superannuation, investments, loans, employee share scheme, RSUs, tax minimization and how to best structure your assets, and of course, retirement planning and how to create an income for life. Most tech executives we speak with have a strong household income, but their investments in super are not where they need to be to maintain their current standard of living in retirement. Our advice caters for this specific situation. So today I'm going to break down the 7 key financial strategies which have helped my clients generate at least $3 million in assets outside the family home to fund a comfortable retirement. Strategy number 1 there, long-term compounding and rule of 72. When setting long-term goals, it's important to understand the rule of 72. Following this rule will give you an indication of how much and where you need to invest to reach your long-term financial goals. So if you expect a return of 10%, then 72 divided by 10 equals 7.2. It'll take roughly 7 years to double your money. So a practical example would be if you had a portfolio of shares, which was valued at $1 million today, applying this rule to your portfolio would just mean that $1 million at 10% will double in value, and hence $2 million in the next 7 years. And again, $2 million would be $4 million in the following 7 years. So most tech professionals I speak with looking to retire in the next 5 to 15 years generally don't have enough assets which should be compounding using the rule of 72. So the question to ask is, will the current trajectory of your portfolio be enough to fund your lifestyle in retirement? One of my favorite quotes from Bill Gates talks about the importance of having a 10-year plan. Strategy number 2 there, savings plan and dollar cost averaging. To begin with, you need to follow a cash flow management system to ensure that you're able to maintain or generate regular surplus. Once we have a surplus, dollar cost averaging involves investing a set amount of money on a regular basis over a long period of time and not worrying where the share market or property prices or interest rates are headed. It makes little difference to the end result as what the market is doing when you begin investing. Once you've committed to the principle of regular investing through a dollar cost averaging strategy, you're exposing yourself to an asset class offering the best potential for capital growth, which is generally the single biggest reason for investing in the share market. In the picture, in the picture on the slide, using a compound interest calculator, a tech entrepreneur of mine, they had 500K in super between mum and dad, and they were able to put in $5,000 per month with pre and post-tax super contributions. Over a 13-year period at 9% return, his super will grow from 500 to 3 million, which is a solid outcome. 3 million at, let's say, 5% income would give you 150,000 per year passive income after tax. This reiterates the saying, timing the market, not timing the market. A lot of people seem to want to stop investing during market downturns, which is generally the best time to be investing because you're buying stocks at a discount. It's called counter-cyclical investing, and Warren Buffett is famous for doing this. Strategy 3, the power of super. People have a misconception about super and often think that because the government keeps changing the rules, they neglect to take advantage of the best tax structure to create your lifetime income plan. Whilst you're working, your super is in accumulation account. Investment earnings are taxed at 15% less any franking credits, which is 32% less tax if you're on the top marginal tax rate of 47%. When you've reached preservation age of 60 and no longer working, you can start a pension. This means tax-free withdrawals from the age of 60. Also, investment earnings are taxed at 0% in pension phase. Plus, you've got full access to your funds, and you can also make lump sum withdrawals as needed. So you cannot get a better return than 0% tax, so it's important to maximize your superannuation. So super is the best tax structure to create your lifetime income plan. So you need to be aware of the super limits and make sure you're taking a full advantage of them. The concessional contribution cap this financial year is $30,000, which includes your employer SGC. Last financial year was $27,500. If you're under the cap, you can make extra contributions to reach the 30K cap. If your balance is under 500K as of last financial year, you're eligible to take advantage of superannuation catch-up contributions for the past 5 financial years. A practical example is when you might have a large CGT bill from selling an investment property. You could make a large catch-up contribution into super to offset the tax payable. The other contribution is a non-concessional contribution which most tech executives I speak to, they're not aware of. It's an after-tax contribution going into super. It's up to 120,000 per financial year. Practical example used for last year, I had a recent business client. They sold their business. Well, last year the cap was 110,000, and then this year they took advantage of the 3-year bring forward rule, so they put in an extra 360,000 in July this year. So that was a total contribution of 470,000, and they're also able to do the same for their partner. So between the two of them, they're able to put in 940,000 as a couple into super. If you include the concessional contribution cap for the last 2 financial years, it just meant that they were able to put in over $1 million into super in a very short period of time, which was a great outcome. Strategy number 4, asset allocation. Look, there's no formula for the right asset allocation for everyone, but asset allocation is one of the most important decisions investors make. It's about deciding how much of your money you want to have in shares versus bonds. Shares are usually referred to as growth assets, while bonds, cash or fixed income, they're referred to as defensive assets, as they're not as volatile as the share market. And your risk profile will largely determine. In saying that, I meet a lot of tech professionals with a large portion of their wealth in cash for whatever reason, but the money could be working harder having it in a growth asset like shares or the property market. So your risk profile should be reviewed every 6 months and adjusted accordingly depending upon your life situation. This is a 100-year look back of shares and bonds. Shares and property have outperformed bonds and cash over the long term. My 6 simple investment principles: the market goes up a lot more than it goes down. Sometimes it goes down regularly. I mean, historically, it might be once every 4 or 5 years. Sometimes it goes down a lot. It always recovers. And as you've seen, it's very hard to predict what it'll do in the short term, but based on the graph, you can always predict what it'll do in the long term. So, which is why I continue to encourage people to maintain their investment strategy. So strategy number 5 now, reducing tax to build wealth. Many high-income tech execs, miss out on opportunities to minimize tax because of poor investment structures and poor tax minimization strategies. So investment structure refers to its legal ownership. Example of this include individual asset ownership, partnerships, trusts, including super funds and companies. And different types of legal structures can often have different advantages. So for instance, investing in super offers a reduced tax rate, as I mentioned earlier, while the family trust allows for income splitting between members, and a company incurs a flat tax rate, which is currently 25%. An investment strategy, on the other hand, is really what you do with your investments in order to get the best outcomes. For example, you might choose to invest in a property where you're the owner. That's the structure bit. But for the purpose of reducing tax through negative gearing while growing your wealth in the longer term, that's the strategy part. Strategy 6, debt recycling, one of my favorites. 2 of the most common questions I get asked is, how do I pay off the debt on the family home faster? And what is the best way to build wealth and create passive income? And so a potential strategy to execute that is debt recycling. Traditionally, people wait until their home loan is repaid before they start investing for the future. As people are now wanting to retire earlier, the time between paying off the home and retirement has been eroded, hence limiting the growth potential of investing. So this strategy works by directing all your surplus cash flow to reduce the non-deductible debt on your home loan. So commissions and bonuses and savings and tax returns, thereby increasing the equity in your home. And over time, equivalent amounts by creating an investment loan, you can release that equity, can be drawn down to invest in growth assets such as shares, ETFs, or managed funds. And so if the above process is repeated consistently in a disciplined manner, it can reduce the non-deductible debt more rapidly. And hence we show clients that based on their situation, how long will actually take to pay off their home loan, but at the same time, increasing their investments to grow their asset base, which will ultimately give them the passive income in retirement. Strategy 7 there, making the most of your employee share scheme and RSUs. I think first and foremost, you need to understand your vesting schedule. RSUs are typically granted over a 3-4 year vesting period. Unfortunately, you pay tax as they vest, which is unavoidable. So you need to be prepared and have a proactive tax management strategy in place. This is a major pain point for a lot of tech execs that we speak to. So second there, you need to align the proceeds from your RSUs with your long-term financial goals. So whether it's retirement savings, renovating a house, or funding education, let your RSUs work towards achieving these milestones. Number 3 there, depending upon your employee share scheme arrangement, you might have the ability to transfer the shares into a more tax-effective structure, like a low-income earning spouse or family trust. This could potentially mitigate future CGT. Number four there, many people have a large portion of their wealth in their company shares, which is a major risk. Should the market have a correction like it did in 2022 when interest rates changed and the tech sector came off. So you should consider this as well when you're participating in your employee share purchase plan. You might be buying more shares at a discount, but that just means that you've got a lot of more money in the one stock. And so you can diversify in many ways, either through a diversified portfolio of shares, ETFs. You could put extra money into super, which would ultimately improve your retirement income. And a little trick there, that in today's high interest rate environment, using the sale proceeds from the shares to potentially pay extra off your mortgage can improve your serviceability, which will allow you to borrow more and potentially leverage into growth assets like investment properties. I found that personal finance is 80% behavior, 20% strategy. So it's important to talk about why people fail financially. If any of these sticking points on the slides resonates with you, know that you're not alone. However, remember that comfortable inaction will not lead to a successful retirement. So implementing these 7 strategies have shown many of my clients being able to generate at least 3 million in assets outside the family home to fund a comfortable retirement. And so if you'd like to apply these strategies to your unique situation, let's schedule a quick call to make this happen. You can book a 15-minute strategy call with me via my LinkedIn profile or website. There is no cost or obligation, just a conversation about your options, and I look forward to speaking with you soon.